Good evening and welcome to the May 2014 live Hangout with Richardson Law Offices. This month we're going to talk about student loan law issues based on some questions that have been submitted from subscribers and viewers of the videos. And when we're finished with our questions, I'm going to talk to you about some interesting legislation that's being proposed in Congress now, which may be of a big help to people with student loans. So, start with our questions. First question is, I'm trying to get into an income contingent repayment plan, but I'm being told that I do not qualify because of the type of loan I have. What can I do? Well, I suspect that it's not the type of loan. It's not per se because it's a Stafford or Graduate Plus or Parent Plus or that sort of thing that's getting in your way. It's how the loan originated. I suspect that the problem is that I'm assuming it's a Parent Plus loan. You're going into income contingent repayment plan. Really, the only people that should be looking at ICR, income contingent repayment, are those that are looking to get into some sort of income-based repayment plan on a Parent Plus loan. The problem is that ICR is only available to direct loans, as opposed to loans originated under the old Federal Family Education Loan Program called FEL or FELP. That program was discontinued in July of 2010, and now all loans are being originated directly through the Department of Education. So I suspect what you're being told is that you can't get your Parent Plus loan into an income contingent repayment plan because it's a FEL loan. So that's kind of the bad news, but the good news is there's a simple solution. It's called consolidation. You're entitled to consolidate or, in effect, refinance that Parent Plus loan into a direct loan so that you can then apply for income contingent repayment. I had a client do that recently. Several FEL loans, Parent Plus loans for his son, and he needed something more affordable. So we applied for consolidation and at the same time asked to be put into ICR. So that's really what I suspect you're running into. It's a simple process, just like a mortgage refinance, where you are taking out a direct loan, student loan, to pay off or refinance that old FELP loan. And then once you do that, you can then apply for income contingent repayment. And that can result in a much lower monthly payment depending upon what your income level is, the size of your family, and the total amount of loans that you have. But that, I suspect, is what's going on. So recontact the loan servicer and see whether that's the problem. But I suspect it is. And if you're here in Southern New Jersey and you're having problems with it, please feel free to give me a call. Just give me a call at 856-686-9910. We'll look into it. Second question, I'm being sued by a company called National Collegiate Trust on a student loan, but I don't remember borrowing from them. Who are they and what should I do? Well, this is not unusual. National Collegiate Trust, you didn't borrow the money from them, first of all. They're not a bank. They do not originate student loans, but they do sue on student loans. What's happening is National Collegiate Trust is it's not just one trust, but it's part of a family of trusts under an entity called National Collegiate Funding. A whole bunch of little trusts, a lot of them are created out of Delaware. And what we're finding around the country is that these trusts are buying up defaulted private loans, oftentimes from banks like PNC Bank, JP Morgan Chase, Bank of America, Credit One, Bank One, and a few others. So they have bought the loan from somebody else. And if they're coming after you, it means it's in default, just like any other private loan, and they want to be paid. Now, if you've been served by this complaint, what I would do is contact an attorney, somebody that handles student loan law. Again, if you're in South Jersey, I'd be happy to take a look at it. Give me a call, and we can. There may be some defenses. There may be some ways of dealing with that lawsuit. But that's who National Collegiate Trust is. It's just they're suing on a private loan. They're not always clear in the way they write the complaint. A lot of times it'll say that out and out that you borrowed the money from them when you didn't. You borrowed it from somebody else. So it can be rather confusing. Check back in your records to see what private loans you have and which ones this might be. Next question is, my son took out a New Jersey class loan several years ago and graduated. I co-signed for him. He died a few months ago. Sorry to hear that. Do I still have to pay? Well, unfortunately, yes. Under the guidelines for New Jersey class loans with HESA in New Jersey or the Higher Education Student Assistance Authority, co-signers are still on the hook for student loans, even though the borrower died. So that's an unfortunate thing, and I'm sorry to have to tell you that, but that's a situation. And pardon me while I get on a soapbox, but it's very unfortunate because the federal system under the Department of Education, if the student dies, then all of the loans die with him. Now, all the loans that the student took out, any Perkins loans, Stafford loans, that's graduate plus loans that went to graduate or professional school, are all administratively discharged upon application and proof of death for that student. In addition, any loans taken out by the parents, parent plus loans, that may have been taken out to aid in that child's education, those also get wiped out. And even, for example, if the parent dies and there are no other living co-signers under the parent plus loan, then that loan dies with him. So in a lot of ways, the way it was intended when New Jersey set up this class loan system is that it was supposed to mirror the federal system. It was supposed to have all these programs and things like that where you would have discharge. But unfortunately, they're not implementing that. They're not implementing an administrative discharge for a class loan should the student die or should one of the co-signers die. Next question is, I had a full-time government job for 3 years and have been making payments under the Public Service Loan Forgiveness Program. I just got laid off. Does that disqualify me from the program? Well, yes and no. In order to qualify, in order to have your payments be given credit under the Public Service Loan Forgiveness Program, they have to be made while working full-time for a public employer or charity or qualifying nonprofit. So your government job, while you were making those payments qualified. But now that you're no longer employed by your government employer, any payments you make while unemployed or employed by a non-qualifying employer don't count. Now the good news is those payments you did make while working for that government employer don't go away. You don't lose credit for them. And understand the distinction. Public Service Loan Forgiveness is not a payment plan. It's a debt forgiveness plan. All right, and it's only available if you're in an income-based repayment plan that can take longer than 10 years. And that's really for practical reasons. If you're in a 10-year fixed repayment plan, then it really doesn't do you any good to have the loan forgiven after 10 years or 120 payments because it's going to be paid off anyway. So if you're in an income-based repayment plan, IBR or income contingent repayment plan, or pay-as-you-earn, which is a flavor of IBR, then and you work for a qualified employer full time, then any payments made under those circumstances go towards the discharge, and you have to accumulate 120 of them. So assuming you were in there for full 3 years and you made 36 payments while working full time for that government employer, those 36 payments still count. They're still there. So if in the future you start working full time for a qualifying employer, you resume payments under your income-based plan, then that's the 37th, 38th, 39th. You pick up where you left off, so you don't lose out on those 36 payments. So that's why it's careful. Also, an important distinction: it's not 10 years; it's 120 payments. So you may end up making more payments than 120 because you're not always working for a qualifying employer or working full time. But once you get to 120 payments, qualifying payments, then you can apply for discharge of the balance. So that's an important thing to bear in mind. Now, you've become unemployed. That's another thing. That's another trigger. The question you didn't ask is what do I do now? While you're unemployed, I would apply immediately for a deferment, especially if you have subsidized Stafford loans. If you're able to make the payments, if you're able to continue to make the income-based repayments, continue to make them so you don't go into default. And income-based payments can be rather low, and they may still be affordable. But if due to your unemployment, you're unable to make those payments, you don't want to go into default, so you should apply for a deferment. I would try first for a financial hardship deferment. You're more likely to have the deferment for a longer period of time, and also it's retroactive to the date the financial hardship occurred, as opposed to an unemployment deferment, which only goes back a maximum of 6 months. So if you've been unemployed for more than 6 months, then you're not going to get coverage for all the payments you might not have made during your unemployment period, because it wouldn't be covered by the deferment. So you want to get into some sort of deferment if you can't afford to make the payments to avoid default while you're unemployed. So those are the questions for this month's Hangout, but I do want to talk to you and tell you about something. Keep your eye on the news. There's a bill that's been proposed in the Senate by Senator Elizabeth Warren called the Bank on Students Emergency Loan Refinancing Act. It's rather a mouthful, but there's some good and some bad in the law, and it's certainly in the early stages, but if something like this comes to a fruition, it can be very helpful for people that have private student loans, and even for people that have that are looking to get federal student loans in the future, because one of the things it does is it lowers the interest rates on federal loans. So if you're originating new Stafford loans, Parent Plus loans, Graduate Plus loans, that sort of thing, in the future under this law, you could be facing lower interest rates. But what's really interesting about this law, what really helps, is say you have a private student loan. This law, if it goes through and passes in its current form, would allow you to basically consolidate or refinance a private student loan into a federal student loan. And that first of all, now it first of all allows you to have all the payment plans, administrative discharge programs, everything that's available for federal student loans can now be available to your private loans if they then become consolidated or refinanced under this legislation. Now, the catch there is you have to be current on your private student loan. You can't be in default, all right, to benefit from this plan. So it's kind of silly. If you're in default, you can't refinance, but I suspect that even though that's what the law says, that as a practical matter, private lender, when faced with the ability to get all their money. Here they have a loan in default they're trying to collect, and this person says, I want to refinance it through this legislation with the federal government. Whether that's going to encourage that private lender to say, you know what, tell you what, make a few payments, we'll work something out, we'll get you current, and then once you're current, you can apply for this program, and then they get the loan paid off. So there's an advantage to the private lender with a loan in default. So that may not be the problem it looks like, but it is, technically speaking, not available if your loan's in default. Now, loans consolidated like that are not available. We were just talking about the Public Service Loan Forgiveness Program. Under its current form, refinanced private student loans would not be available. It would not qualify for that discharge program. But even so, there are a lot of advantages to this legislation. It's not all good, but it's not all bad, and I think it's going in the right direction. And I think it's finally the government recognizing the problem that we have with student loans in this country, with over $1 trillion nationwide, roughly 15% of that being private, and the default rate is going up. So it's a real problem in this country, and I'm glad to see that Congress is at least looking to do something about that. So if you have some private student loans, or you're looking to maybe in the future to get student loans and you want a lower interest rate, keep an eye on this law and what Senator Warren's trying to do. Again, it's called the Bank on Students Emergency Loan Refinancing Act. So Google that, see what's going on the web, see what the story is. I'll try and post things to my website at www.richardsonlawoffices.com about what's going on with that law, and keep track, and hopefully we'll get some relief for private student loan borrowers. Well, that's it for this month for the May Hangout. Next month is the Hangout's going to be on June 26th at 5 p.m. The topic is going to be New Jersey traffic laws. So if you've gotten any tickets, or you know anybody who's gotten some traffic violations, be sure to send in the questions. You can tweet them to @SJRLaw, or you can email them to me at steve@richardsonlawoffices.com. If you're on Facebook, you can go to facebook.com/richardsonlawoffices. Feel free to like the page and post on the page what your question is, and I'll try to answer them next month. So, enjoy your Memorial Day weekend. We'll be heading into summer, and I'll see you on June 26th to talk about New Jersey traffic laws. See you then.